All right, let's dive in. Today, we are talking about one of the most powerful and maybe one of the most misunderstood tools in finance, stock options. Think of this as your starter pack, your foundation for understanding how these things really work. Whether you're looking for an edge, a way to protect your investments, or just a new way to look at the market, you're in exactly the right place. So let me just start by posing a question. What if there was a way to get in on a stock's big upward move, but if you were totally wrong, you could put a hard, absolute limit on how much you could lose? Sounds pretty good, right? Well, that's not some fantasy. It's the whole idea behind why options are so compelling. Okay, this right here is the single most important definition you need to burn into your brain. See, unlike a stock, an option is a contract. And the magic words are right, but not the obligation. This means the person who buys the option gets the choice to do something. They don't have to. And it's that choice, that power and flexibility that is literally what's being bought and sold. Now, this whole world of options is really built on just two very simple foundational tools. You can think of them as the two sides of the same coin, calls and puts. Let's just boil this down to its absolute essence. A call option gives you the right to buy a stock at a pre-agreed price. You buy a call when you're feeling bullish, when you think that stock is headed for the moon. A put option, well, it's the exact opposite. It gives you the right to sell a stock at a set price. You'd grab a put if you're bearish, if you think that stock is about to take a nosedive. Simple as that. Calls for up, puts for down. Okay, so let's really dig into this from the perspective of the person who's actually buying one of these contracts. What are they signing up for? And maybe more importantly, what's their real risk? So, say hello to the option buyer. This is someone who sees a potential move coming in the market and they want to make a calculated bet on it without having to risk a ton of their capital. So here's the deal for the buyer. They pay a fee. It's called a premium, and in exchange, they get that powerful right we just talked about. And because they have zero obligation if the trade goes sideways, they can just let the contract expire and walk away. Their absolute maximum loss is just that premium they paid at the start. That's it. What they're really hoping for is a big, dramatic price swing to make their bet pay off big. This table shows you exactly how that risk is capped. Look here. Let's say the premium they paid was 95. If the index finishes at 17,400 or 17,500, anywhere below the break-even point, their loss is stuck at exactly 95. It can't get any worse. But once the index moves past that break-even point of 17,595, their profits start to kick in. At 17,700, they're up 105. At 18,000, they're up 405. And it just keeps going up from there. And this, right here, is the holy grail for an option buyer. It is an asymmetric bet. The risk is known, it's defined, it's strictly limited from the second you make the trade. But the potential reward? Well, in theory, it's unlimited. And that is an incredibly attractive setup. But for every buyer who gets that amazing right, there has to be someone on the other side of the deal. There has to be a seller who takes on an obligation. And here they are. This is the option seller, sometimes called a writer because they're literally writing or creating the contract. They're the ones who sell the contract and collect that premium from the buyer. You can kind of think of them as the casino in this situation. The seller's profile is a perfect mirror image of the buyer's. They get that premium as instant income, but, and this is a huge but, in return, they accept an obligation. They are on the hook to either buy or sell the stock if the buyer chooses to exercise their right. So what's the seller's dream scenario? That the stock price just stays put. They want the option to expire worthless so they can just pocket the premium. Their profit is capped at that premium, but their risk? That's a whole different ballgame. And just look at the seller's payoff chart. It's the exact inverse of the buyer's. As long as the index stays below that 17,595 break-even point, the seller keeps the entire 95 premium. That's their max profit. But the second the index climbs past that point, their losses start to mount. At 17,800, they're down 205. At 18,000, they're down 405. The higher the stock goes, the more they lose. And there it is, the seller's trade-off in a nutshell. They accept potentially unlimited risk in exchange for a reward that is absolutely capped at the premium they collected up front. It is a fundamental bet that the big, exciting move the buyer is dreaming of just isn't going to happen. So all this talk about the premium brings up a really important question, right? How is that price, the cost of the option, actually figured out? It's not just a random number. There's a real science behind it. An options premium is really a mix of these 5 key ingredients. You've got the stock's current price and the option's strike price, of course. But the other two big ones are time and volatility. Just think about it logically. The more time there is until an option expires, the more chances the stock has to make a huge move, right? So more time means a more expensive option. And the more volatile a stock is, meaning its price swings around like crazy, the higher the premium, because there's a greater chance it'll make one of those big, surprising moves. And this quote right here touches on something absolutely critical. That time part of the premium, it's constantly disappearing. Think of it like a melting ice cube. Every single day that goes by, a little piece of the option's time value melts away until it hits 0 on expiration day. This is called time decay, and it's a constant enemy for the option buyer, but it's the best friend of the option seller. So as we start to bring this all together, it's so important to remember that options aren't toys. They're sophisticated financial tools designed for a very specific purpose. And really, it all comes down to the number 2, because every single options contract has 2 sides. You have the buyer, who's paying a fee for choice and for strictly limited risk, and you have the seller, who's getting paid to take on an obligation and all the unlimited risk that comes with it. It's a pure transfer of risk for a price. So in the end, options offer this incredible power of leverage, and they can act as a kind of insurance for your portfolio. But that power is not free. The price for that power is risk. The buyer pays that price with a small, known premium. The seller gets paid that premium, but in return, they agree to take on a much larger, sometimes unknown risk. So the final question you should always ask yourself is, in any trade, who is actually paying the price?